Hello, my name is Christian Rangel, and today we will be giving our presentation over our team. Our team name is the GCC Revolutionaries, which stands for Gary, Caitlin, and Christian, and we are Industry I. I hope you enjoy the presentation.
Company I's team was comprised of MBA candidates Caitlin and Gary, Jerry Rivette, and Christian Rangel.
Hi, my name is Jerry Barrett of GCC Revolutionaries. I want to go over our strategic vision. Our vision at GCC Revolutionaries is become the leading provider of low-cost, widely accessible products worldwide, prioritizing affordability over premium features, focusing on essential functionality. We aim to differentiate our business from competitors in order to capture the largest possible market. Our motto is value for all, reflects our dedication to delivering cost-effective solutions that meet fundamental needs. This is our initial 3-year strategic plan from 14 to 16. As you can see, we kind of shot, a little bit lower than what we anticipated, which in turn caused our overall numbers, our projections actually to be, in the very low, $1.83, $1.86, 81. It was at this point, after a 3-year strategic plan, that we decided to get together and bring in a consultant to try to figure out where we needed to go and how to improve our business.
The Revolutionaires, our vision was to become the leading provider of low-cost, widely accessible products worldwide, prioritizing affordability over premium features. By focusing on essential functionality, we sought to differentiate our business from competitors and capture the largest possible market. Our motto, value for all, reflected our commitment to delivering cost-effective solutions that met fundamental needs. The company employed a global differentiation strategy that set its footwear apart from rival brands through attributes such as lower SQ rating, thus lower pricing, high TQN, increased advertising, greater celebrity appeal, higher mail-in rebates, and an extensive network of retail outlets carrying the brand.
Hello, so I will be going over our annual total revenues for our simulation. We can start with year 11 all the way to year 19. So from year 11 to year 14, we had an upward trend in our profits and our annual total revenues. It kept improving, and the biggest improvement at the time was year 12 to 13. That was due to because we got into the private label markets. Our first year we had 0 in private label, and then year 12, 13, we hit that 22.2% in private label, which boosted our total revenues. Our total revenues in year 14, which was the highest peak, and it was at 884,547. And we've seen that we've had to keep improving. We've seen that Team G and Team A were over $1 million, and we were wondering what can we do. So at that time, we were like, we need to improve our SQ rating on our products, and we need to enhance our marketing, celebrity endorsements, and this, in turn, is what we thought would improve our profit margins. But in year 15, it declined onto year 16, which was our biggest hit at that time from year 14 to 16. So we wondered, what can we do different? So in the beginning, we had a vision that we wanted to create sort of like Nike's that had high models available, high SQ, really high quality in the shoes. But when we looked at the entire market, we seen that this market was overflowed with competition. And we said, let's try and hit this lower market of still high models available, but at a lower price, lower SQ, make it more accessible to everyone around the world. And in year 17 through 19, we seen that change. Well, from year 17 through 20, we've seen that change, just an upward trend of all of our revenues go up. So in year 17, we hit 1.51 million, which was the highest revenues that we made at the time. We couldn't make it over $1 million, which was really positive enhancement in our market. In year 18, we went up to 1.4 million, which was a really high jump. We actually got a Leapfrog award in that year. And in year 19, we kept our trend of going up to 1.725 million, which is our highest net sales revenue and annual total revenues throughout the entire simulation. And our final year 20 was at 1.66172 million, which we are really happy with. We came out as the top performing company in the entire industry of our class. So we're really excited about that.
As you see here in our EPS chart, that we started out really slow in the beginning. We were, like I said, we were hovering there in the bottom half of the industry. And it went to after, our first 3-year projections, in which we all decided to get together and bring in a consultant relating to video. We just watched in class here not too long ago about, a man bringing in people, that are smarter than him to help his business grow. Kind of what we did, in a sense. And as you can see, come around year 18 and throughout year 20, where we kind of leveled off, we made a complete turnaround just by bringing in expert advice to help us improve our business.
Looking at the annual return on equity investment, we can observe the following. An initial decline from year 11 to year 13, the ROE shows a consistent decline, which signaled a period of lower profitability and ineffective use of equity. Moderate recovery and fluctuation in years 14 through 16 showed some improvement, though there was not a consistent upward trend. The values slightly fluctuated within a range. Sharp growth starting from year 17, ROE experienced a dramatic increase, especially in years 18 and 19. The company's financial performance improved significantly during this time period. Stabilization in year 20, the ROE is still strong at 43, but has decreased from its peak at 55 in year 19, suggesting some normalization and return to stability. The ROE data shows our company experienced a period of decline, followed by a strong recovery and sharp fluctuations, particularly in the later years. The company underwent a significant improvement in financial performance from year 17 onward. Although ROE has started to stabilize and decline by year 20, this pattern in our organization shows that we faced challenges in the early years, but eventually recovered and grew our efficiency in generating profit from equity.
Hello, so I will be going over our annual credit rating. So I made 2 different graphs. The left graph is a snapshot from year 11 to 20 and all the credit ratings that we made. And then on the right is a overview of 3 statistics that I thought would be important. So for the left, as you can see, we started the year with B12 as everyone else did. And from year 12 to 18 is really the time when we were trying to improve our credit rating, but we couldn't figure out how to do it at the time. So, and then as you can see, from year 18 to 20 is when we made the big improvement. And finally, we ended up the whole entire simulation with the A+, which we were really happy about. That was actually our best performing year for annual credit rating throughout the entire simulation. So our worst years were in year 13 and 17, but the difference between these 2 years is we had 2 different strategies. And for year 13 at the time, we were trying to create that high value product. But at the time, we didn't know it. That was a really highly competitive market. Now, in year 17 is where we made that switch in our strategy. That's when we lowered our SQ ratings, lowered our expenses, and in turn, that made our credit rating go down at the time because we knew that we had a trust in the process. And this meant at the time we had to take out some loans. Throughout the entire year, we had to take out loans. It wasn't until the later years when we didn't have to take out a loan. We were actually paying back our loans, which we were really excited about. And that's how we ended up with the A+. Now, in year 16, that's when we had to do our second 3-year strategic vision. At that time, we stated, hey, if we incrementally improve our credit rating from a C to a C+, to a B- to a B, to a B+, A-, and then an A, we would end the entire simulation with the A, which we were striving for. But as you can see that next year, we dropped down to a C-, so that had to change our strategy on that, on our credit rating strategy. And in turn, our entire simulation, we ended up with an A+, which was tied with the best throughout the entire industry, which was a really positive outcome. And throughout this, we had our Bullseye Awards and our Leapfrog Awards. Our Bullseye is for us to, our performance projections, not to vary more than 5%, and our image rating to vary no more than 4 points. We ended up with having in year 20 to have 3 cumulative awards, which boosted our score on scoreboard. And also for our Leapfrog awards, we got it in year 17 because we improved our score from a 38 to an 87, which was a big improvement. And in the entire end of the simulation, we ended up being happy with our annual credit rating. Thank you.
Stock price for me was always one of those things I wanted to see continuous improvement in over the years. And it took some understanding of learning, of getting our debts paid off, of getting our credit rated up, of getting our revenues back up. So in order for us to see an increase in our stock price, but you can see year 13, we were, really struggling to find what it is that we needed to do. And, being able to sell back shares, paying out dividends, whatnot, we've seen increase, but it's definitely a revenue spike. When we learned how to get the EPS up, then we really started seeing the increase in our stock price and made a complete turnaround and finished the year 19, year 20 in the top spot.
Looking at the image rating of our company from year 11 to year 20, we can summarize the overall trend. The image rating improved significantly in the first few years, from 65 in year 11 to 94 in year 14. This is an increase of 29 points, which suggests a positive shift in the company's public perception during this period and its social corporate responsibility efforts. After peaking at 94 in year 14, the ratings dropped to 84 in year 15, and then further declined to 79 in year 16 due to a shift in priorities our company had. After the decline in year 16, the company's image rating improved again from 79 in year 16 to 90 in year 18. This marked a strong recovery and positive growth for our team. This rating stabilized around 88 to 86 in the last few years, year 19 and 20, indicating a plateau where the company's image is relatively stable. But in these years, our company worked to achieve the Corporate Social Responsibility Award and also bonus points.
This is a few of the awards that we have received throughout the simulation, and I may have missed a few here, but I definitely want to hit on that. We did hit the Bullseye Award in year 20. I'm sure we've hit it, more years than that, if I went farther back. I just want to kind of brush up briefly on a few things. Leapfrog Award, we definitely won that. We started seeing that trend year 13 when we first hit our, 3-year projections. But, our projections were off, which kind of brought us down a little bit, in which that's where we hired a consultant. Year 17, you see a major leapfrog change, with our points. And then our corporate responsibility definitely made a turnaround there and was able to close year 17 and year 20 out with the top spot for that.
On this slide, I'll be speaking about outperforming our competition for the next 2 years. There was 2 more years of the simulation available. So currently, how we are standing, we are at the top of the industries on the first place. But if there was a continuation of the next 2 years, 3 of the main factors for both wholesale and internet segment I will speak about. So for first, the wholesale segment on the left-hand side, our strategy for outcompeting rivals in the wholesale segment over the next 2 years will focus on our price, market share, and celebrity appeal. To go into further detail, for our price, we will maintain the lowest wholesale prices by further optimizing production costs and supply chain efficiency. Second is our market share. So we are going to expand our partnerships in some of the markets that we weren't able to capture those wholesale markets and try and boost those over 20% if possible. If not, over 30% would be amazing. And we will also focus on retaining our existing wholesale markets. Next is our celebrity appeal. We will showcase our celebrity endorsements. We will try and capture more. In one of our years, we had 5 celebrity appeals, and we had the highest celebrity appeal across all the industries. So we will try and do that. As we are near 20, we have more revenue available to purchase more celebrities. So we will try and do that. If possible, we will even try and get as many as possible. And this would boost our product visibility and perceived value to customers. Next, for outcompeting our rivals in the internet segment, our internet segment, our actions will emphasize on price, search engine advertising, and also market share. So 2 similar ones to the previous one, but also we will add this search engine advertising. So first, our price is we will continue to undercut competitors with the lowest price while maintaining reasonable profit margins. And our search engine advertising, similar to celebrity appeal, is we are going to increase our investment in search engine advertising to drive traffic directly to our market. Third is our market share. We will try to expand into more online markets, and we will do this by more investments into market share promotion, celebrity investments, and search engine advertising. And by concentrating on these, we'll have affordability, visibility, and market penetration. Our team will solidify its competitive edge across wholesale and internet segments. Thank you.
For our internet market strategy, we implemented a pricing strategy that ensures that our retail price always exceeded our wholesale price by 40 to 42%. This pricing structure allowed for a healthy margin while maintaining competitiveness within the market. By setting a price that benefited both the retailer and our business, we created a win-win scenario. Retailers could still offer products at a competitive price while we still ensured we were profitable. The retailer was incentivized to sell our product while feeling they are benefiting from the price structure. Thus, we fostered strong relationships that almost doubled the number of retailers that we had overnight when we implemented this pricing strategy halfway through the game. Search engine advertising strategy, we maintained search engine advertising efforts at around 20% higher than our competition. This ensured that our business was more visible than competitors in search engine results, driving more traffic to, say, a website. We stayed ahead of competitors and ensured that our products were seen by a larger audience. This increase in visibility led to a higher customer acquisition and potentially greater sales. The higher ad spending increased our brand exposure, leading to more website visits, higher engagement, and more sales, as our brand remains top of mind among many consumers. Shipping strategy adjustments. Initially, the business offered free shipping to attract customers and increase conversions. After assessing the market and customer behavior, the decision was made to stop offering free shipping. Instead of focusing on free shipping, the strategy shifted to boosting celebrity appeal and enhancing marketing efforts. This focus was now on leveraging the influence of celebrities to attract attention and create a strong brand identity. Marketing efforts are concentrated on utilizing star power to enhance brand credibility and drive consumer interest. By replacing the free shipping offer with celebrity-driven marketing and search engine advertising, the company shifted its emphasis to brand prestige, which can appeal to different segments of the market and were lower cost than offering the free shipping. This combination of pricing, advertising, and celebrity-driven marketing forms a comprehensive internet marketing strategy that we focused on visibility, profitability, and brand prestige while aligning with the shifting consumer preferences and competitive pressures within our industry.
Hello. So on this slide, I'll be talking about our wholesale marketing strategy. And for our wholesale marketing strategy, we adopted a global differentiation strategy. And we switched our differentiation strategy from our before ones to our second 3-year performance because we want to tailor our wholesale market with a focus on offering the lowest price, lower quality products to capture the largest possible market share. And we did this in our final or throughout the simulation. So this approach enables us to meet the cost-sensitive demands of wholesalers while maintaining consistent profitability. Some key elements of our strategy. The first one is our cost leadership. So we do this by leveraging economies of scale and efficient production processes to minimize our costs. Second is our market penetration. So competitive pricing tailored to undercut our rivals in the wholesale segment and also our internet segment. So third is our customer relationships. We do this by, we build loyalty through our reliable customer service, and we would just keep going higher and higher in those reliable customer services and try and be higher than everyone else. Next is our strategy over time. So our strategy has evolved over the years that I spoke about to adapt the regional demands and competitive pressures. So for our North America wholesale priced retailers, it was at $60. For Europe, Africa market, it was 63, Asia Pacific 59, and Latin America market, it was $60. So our North America and Latin America market were both the same, while Europe was the highest because it's how the market was, and Asia Pacific market was $59. We had the same strategy of global differentiation throughout all four of the different markets, but as we looked at the market demands, what they're willing to pay, what everyone else was pricing theirs at, we had to adopt those changes in each of those markets. Our operating profit margins were all over 20%, which our highest is in Asia Pacific. And our wholesale market share for year 20 was 15.4% in North America, 18.4% in Europe, Africa. Asia Pacific was 16.1%, and our Latin America market was 17.6%. Thank you.
Our private label strategy was pretty simple to the book. We want to keep our retail prices the lowest above, all the other companies that were involved, or at least, competitively low. Our SQ rating, we kept it bare minimum to keep our production costs down. There was a couple years there where we did not sell everything that we produced for the private label section, but as we started getting toward the latter years of the simulation, we noticed that, as we kept our production costs down and kept our shoes consistent, we were beginning to sell and continue to sell all the pairs that we produced for that market, and therefore it helped us keep our revenue streams up.
For our production strategy, we aimed for an SQ rating of 7 or higher. This meant we set ambitious quality targets for our products, striving for an above average quality in the marketplace. However, our company didn't prioritize TQM at this stage. Instead, the focus was on sheer number of models produced. The idea was to diversify the product range, even if it meant quality control was not rigorously maintained across the board. Our company strategically maximized private label production, meaning we made products for other brands, ensuring steady revenue. Branded production was then used for our own lines, but only after private label orders were filled. Our company made an excellent move by purchasing options A and B to serve North America, Europe, Africa, and Latin America, securing our presence across multiple markets. But in Asia Pacific, we bought option C, which turned out to be a mistake. The reject rates were much higher in Asia, leading to a significant issue with production capacity in that region. To anticipate our growth, our company constructed extra production space and equipment early on, as we knew there would eventually be a depreciation event, but planned for future capacity. Sales were focused on producing and selling mainly within the same geographic location. This allowed for streamlined operations and lower logistical and tariff costs. Our company maximized inventory clearance whenever there was a positive return. This helped manage overstock, freeing up cash and ensuring cash flow and ensuring products didn't linger in inventory too long. As our company moved forward, our production strategy evolved. When we shifted strategy, our SQ rating remained steady around 4.0, and our company prioritized TQM, a shift to a more structured, comprehensive quality management approach. When more SQ was needed, we added superior materials to the product, ensuring we met that desired quality level. We continued to max out our private label production, maintaining a solid revenue base from those contracts, pricing at our competition's lowest price the year before to ensure that the contract was received in all areas. Any remaining capacity was still allocated to branded production. By this time, our company stopped purchasing extra space and equipment. We shifted focus to paying down debts, prioritizing financial stability over future expansion. Instead of focusing on just one geographic region, our company divided shoes across multiple locations, choosing regions where the profit margins were more favorable, optimizing earnings. Lastly, our company remained consistent with their inventory clearance strategy, only clearing inventory when there was a positive return, ensuring we didn't over-discount or hurt our profitability. Our company's production strategy evolved from an early focus on quantity, and geographic expansion to a more refined approach centered around quality management, financial stability, and strategic geographical distribution. With a balanced approach to inventory and continued focus on branded production, we set ourselves up for sustainable growth in the long term.
Hello. So this is our financial strategy presentation slide. And our approach to financial decisions is grounded in supporting our global differentiation strategy that we adopted. And here's how we manage these key aspects of our financial performance. I made a graph below saying the 4 different ways for our financial performance. The first is dividend policy. So during our management period, we have adopted a balanced dividend policy aimed at providing consistent returns to shareholders while reinvesting heavily in our global market expansion to the 4 different markets. So our dividends have been set at year 20 at $8.25. Our dividend payments to shareholder is 149,234,000 in year 20, and our dividend payment or our dividend payout is 44.4%. This is reflected by our commitment to financial stability and shareholder value. Over the next 2 years, if we achieve our earnings per share targets, we plan to increase our dividends by 5 to 10%. This ensures payouts align with sustained profitability. Next is debt versus equity. So we prioritize a mix of debt and equity, and leveraging debt for expansion opportunities while ensuring a manageable debt to equity ratios. This approach has helped us maintain flexibility in our industry. We have a debt to equity ratio of 0.9%, which is very excellent. Investopedia states that anything below a 2% is what companies should strive for. Next is our stock actions. So we have avoided issuing additional stock in these final years to prevent shareholder dilution and instead focus on potential repurchases to enhance shareholder value when appropriate. We actually repurchased 300 shares of stock at $467.97 our final year. And our credit rating actions. So to sustain a strong credit rating, we have an A+ in the final year. Is how we do this is we monitor our cash flows. Our strategic repayment of high interest debts have been a priority to lower our financial risk, and we try to repay our high interest debts or our high interest loans before our lower interest loans. That was our strategy, kind of like the snowball method. And through these strategies, our team ensures a robust financial health while supporting our overarching business goals. Thank you.
I'll go ahead and enclose the last game to date scoreboard, which has us finishing the top spot. But for the longest time, we did hover around the bottom half, 6th, 7th place, for the first 5 years. Surprisingly, company G was leading, through those early years, and it was surprising to see them finish so bad. I don't know if they had people drop out or whatnot. But Cloudwalker seems to develop the similar strategy to us because they were always kind of, they started out real slow. And it was nice to see them finish there on the 2nd spot. Team B, they've been pretty consistent all year. They've been top 5, top 3 most of the year if they weren't the top spots. So good to see them finish 3rd place. But those were the competitors.
In the early years, our company's price, SQ rating, and product line breadth were too close to the competition. This approach didn't allow our company to stand out. We were essentially mirroring the current market leader without carving out our own unique position. Instead of developing a differentiation strategy, our company focused on playing catch up and simply trying to emulate the competition's success. This lack of distinct identity and strategy resulted in lost market share, as customers had no compelling reason to choose our company's products over competitors. The attempt to stay competitive by imitating others led to high operational costs, which reduced our profit margins. Retailers were also lost, as they saw no significant advantage in selling our company's products compared to the others available in the market. We needed a shift in strategy. We decided to lower our SQ rating dramatically below that of the competition. This move aimed to differentiate our company by focusing on other value propositions like price and volume, rather than competing head-to-head on quality. Our company maximized private label production to generate consistent revenue. By doing this, we ensured a steady income stream, even as we shifted our focus away from competing directly with premium brands. The remaining production capacity was used for branded pairs, enabling our company to still invest in building our brand without overextending ourselves. We raised the wholesale price and the price for internet market pairs to maintain around 30 extra pairs of surplus. The price for internet market pairs exceeded the wholesale price by 40 to 42%, positioning online products as more profitable while still maintaining a competitive edge in the market. With these changes, our company was able to create a significant competitive advantage. Retailers doubled overnight in terms of sales volumes when they saw a new pricing structure and the shift in strategy. By adjusting SQ and focusing on private label, we improved our market position and regained retailer confidence.
So this slide is the wrap-up slide of our entire presentation. This is the what we learned portion of the slide. I wanted to highlight some of the different aspects and talk about some of the awards that we received, our placement, and how we worked as a team. So for the first part is our weekly market analysis. Each week we would meet on Zoom around 7 o'clock towards later in the night. And some of the days we would go all the way until 12 o'clock. And some days would be lower, meet about 2 hours, an hour. And in doing this, I believe that if you put in the time, it's going to pay off. And that is what happened for us. We would go over the different benchmarks, the different efforts pages, the financial statistics. We put in the time and we looked at what everyone else in the market was doing. And that's how we catered our market strategy. So towards the beginning of the simulation in year 11, before we even met up, I believe all of us were watching YouTube videos, doing as much research as possible, because we all wanted to be educated on simulation. There was a YouTube video that I believe most other participants in this whole entire simulation watched. And in this YouTube video, it told you to produce high models, to have high SQ, high price, kind of like the Nike of the shoe market. And in the snapshots in the dark blue, I labeled it competitive market because I believe this is what most everyone else was doing. As you can see, there's a cluster of competition right there. And in the beginning years, that's where we also were. But towards the end of the simulation, we switched our entire strategy. And that's how in the red arrow, our team we switched our entire strategy to have a different market. We wanted to be that lower SQ, lower price, but hit as much market as possible. And this is where it improved our standings in the simulation. So in those screenshots, the littler those bubbles are, the lower market you have. And the bigger the bubbles are, the higher market you have. And as you can see in Team J and Team G in both internet and wholesale segments, although they have a differentiation strategy similar to us, they had low market. For us, our bubbles are really big, and that's kind of a image of how the market is looking. So some other awesome things that we learned and we received is in years 18 and 19, we received 2 different awards from the BSG corporate offices that stated that we played worldwide for our industry and return on equity, which was a really fulfilling feeling. As soon as we got that first year and we had a group meet together and we were all excited saying, "Good job, team." And it showed that our hard work was paying off. I believe that you received these awards as well. They said they were going to send them to the professor. And in year 20, we checked and we became the top performing industry in the entire competition, which was really exciting. Some ways that we achieve this is one big thing was our celebrity endorsements. So you could put money into your marketing, but this only took you so high. What we do for our marketing is we look at the industry average and try and go up about like 20% to improve that marketing. But also for our celebrity endorsements, one year we had 5 different celebrities. So this really differentiated us from everyone else because we seen what everyone else was doing in their marketing, and we wanted to do bigger and better things than them. So we also got our leapfrog awards that Gary has spoken about. we had our Bullseye Awards, which just boosted our overall score in the ends. We ended with over 100% in the class, which the simulation is 25% of our grade. So we took this serious and it paid off. And I believe that I could speak for our whole team that we all learned so much in this simulation about looking at finances, different benchmarks, how to put more money in TQM and SQ ratings, which would improve um, our overall financial statistics. All three of us are MBA majors, and this is our capstone. So we will be graduating here coming up in a few weeks. So seeing those awards come in at the very end of the simulation really was fulfilling for all of us. And thank you for watching our presentation and hope you have a good day. Bye.